The Schroder AsiaPacific Investment Trust is managed by Richard Sennett and Abbas Pakoda and owns a portfolio of predominantly large cap Asian equities, which they select with the bottom up stock selection approach. They predominantly focus on quality companies with a consideration for valuations. As such, stock selection should be the primary driver of performance, which it has been over the long term. However, more recently, the trust country and sector allocations have had a notable impact on returns. Over the course of the year to the end of September 2024, the manager's long-standing underweight to China was beneficial to returns, although Taiwan was the country with the biggest contribution to performance. A considerable portion of this was down to stock selection, with the managers having a large allocation to tech companies such as TSMC and MediaTek. These companies enjoyed a particularly strong period, especially earlier on in 2024. Both the Philippines and Singapore markets delivered double-digit returns over the year. Both markets are overweight allocations for the trust, which help performance, with stock selection in the Philippines also proving particularly positive. As such, the country was the second best positive contributor to performance. The biggest highlight from the country was international container terminal services, which performed notably well. On the other hand, India was the biggest detractor from performance over the year, which was primarily driven by stock selection. Despite this, there were some highlights, with one of the trust's best relative performance being Oberoi Realty. Whilst the 12-month period to September was positive for the trust's positioning on the whole, the final quarter of the period saw the announcement of a raft of stimulus measures in China. This led to a rally across the region, though most notably in China. In this near-term period, the manager's underweight allocation to China was a headwind to performance, though this was somewhat offset by the overweight to Hong Kong. The managers continue to be underweight China due to structural concerns over the country, though have been narrowing this underweight throughout the year as they have selectively identified good value opportunities. The third quarter move in markets also dragged on the trust holding in Korea and Taiwan. Looking forward, the manager's outlook has been encouraged by what they believe are easing macroeconomic conditions for the region. Factors such as rate cuts from the Federal Reserve and the subsequent weakening of the US dollar are typically supportive factors for Asia. However, we note that the recent re-election of President Trump in the US may impact this. The recent stimulus in China has also buoyed investor sentiment. While so far the biggest moves have been in state-owned enterprises, the managers believe that if this positivity feeds down into Chinese consumer sentiment, it could help drive a recovery in the real economy. The managers also believe that earnings will be very important for the outlook for the region, as they will determine whether valuations are justified across the region. They highlight that aggregate valuations remain reasonable versus their long-term averages, although the picture is more diversified on a country level, with India being towards the higher end of its historical range, whereas Philippines is towards the lower end. As such, the managers remain very selective. In our opinion, the past year represents another period of robust performance for SDP. In absolute terms, the trust has delivered good returns, and the outlook for the region is arguably improving on a macro level and seeing improving investor sentiment. We believe SDP offers investors exposure to the ongoing growth trends in Asia with the potential for long-term alpha, while also potentially being a lower risk way of capitalizing on a recovery in the region due to the quality focus and valuation discipline. Furthermore, the current discount could offer a compelling entry point, as the share price has failed to keep up with the good absolute NAV performance. We don't believe the current level reflects the improving prospects for the region, nor the long-term success of the strategy.